what's our kind of broader view in terms of what clients and investors can think from a forward-looking return perspective?
The challenge going forward is going to be that valuations across nearly all areas of the financial markets are relatively expensive. We don't necessarily think we're in bubble territory, but I think it's important for investors to acknowledge that valuations are stretched under any type of historical metric. And for that reason, for investors at this point of the recovery period, with so much economic fragility, people just have to bring their return expectations down a bit lower than they've grown accustomed to. And then unfortunately, of course, on the other side of the ledger, we expect volatility to be elevated. So low returns, higher volatility is the exact opposite of what we look for as investors. It's going to create a much more challenging environment over the next 3 to 5 years than we've become accustomed to.
Any final words in terms of investment implications or considerations as so many of our clients look to navigate these disruptions?
Going back to my initial points, when comparing the level of yields, the level of spreads, the level of equity markets from a valuation perspective today versus almost 12 years ago during the last crisis, they're high. And in some sense, we may have reached something resembling the destination in terms of beta returns, which means on a go-forward basis, having flexibility in terms of a mandate, focusing on good old-fashioned relative value alpha creation over the next 3 to 5 years is likely to be a much more significant contributor to overall returns than it's been over the more recent history. So again, patient, flexible capital, taking a very active approach to industry security and sector selection, we do think will pay dividends over the next 3 to 5 years. And of course, we remain very, very diligent and focused on, of course, delivering in terms of investment returns.